This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe. Welcome back. So what I'm going to do today is I went back through old videos and was somewhat surprised to find that I had not done a video on how many stocks to hold or how many stocks to trade. Depending on your style, if you're a short-term trader versus a longer-term trader, I do think there's a difference in how many stocks to play. But I want to at least give you a framework. These aren't hard and fast rules, but I think they'll give you a good framework to understand how to manage risk in these situations. Let's go ahead and get going with this. Now, some of the techniques that I talk about in this channel, you can find in this book called Invest Like a Pro. It's at rabilstockresearch.com/book if you want to get more information. Let's just start with the day trading approach and what my thoughts are here. So one of the things I've done up here in the upper left is I've put the different time frames that you could use for a day trading purposes. All right, now I'm showing the 60-minute, 10-minute, 2-minute combo. All right, now up here on the left, you're going to have a daily no matter what these are. You're always going to have a daily on the bottom left. And the reason I do this is not for the indicators or anything like that. What I'm actually doing with the day trading is I want to see what the last 3 or 4 daily bars look like, where the open is, where am I in relation to the 4, right? Am I green? Am I red? Am I running into resistance? Is there a midpoint that's important? Am I coming into the 18 or the 40? Stuff like that. So I'm really one of the things I really like to look for the daily on is, the open. So if I open, let's say we get a nice firm bar like that, and then the next day I open like this. So we've got a 4 that's rising, and I've got an up move with a good green bar, and I open down here. Okay, well, I'm thinking up, right? I'm looking for a positive signal. So I really like to look for that pattern. Now, let's say I've got a move where the 4 is like this, and I've had a couple of good bars, right? And then I open like that, and the 4 is way down here. Well, what am I thinking? I'm thinking I'm looking for a short. Okay, so keep an eye on this. This will dramatically improve your day trading, I think, because it'll improve your bias, recognizing where you are in relation to the 4. Now, in my course, I go into this in detail. The first module, the first whole section is based on how to use these daily bars this way in relation to the 4. All right, now I've got the 60, the 10, and the 2. The way this works is we use the 60 kind of for our bias. It would be like if you're looking at a longer term chart, you start with a monthly and then you go weekly, daily. Well, in this case, this would be the 60 would be like the monthly, right? And we're looking at what the bigger pattern is, what's the bigger trend, where's the support and resistance levels, how much room do we have, what kind of momentum is in place on the bigger picture. And then I'm going to go and look for signals on the 10-minute and trigger them off the 2-minute. All right. Now, again, and I'm spending a few extra minutes on this because I think this is important. Now, if you're more interested in day trading, being active day trader and doing a lot of trades over the course of, say, a morning or an afternoon, I would suggest going with the 35-1 combo. You're going to get a lot more signals with a 5 and 1. All right. And then the 60-10 is kind of like a compromise in between. 15 can be a little bit slower. The 78-15-3 is a little slower, but I will say that I do think those signals are going to be more reliable. Okay, because you're not spending a lot of time in the smaller dinky time frames. When you get down under, anything under 10 minutes, you start to get a lot more noise in the charts. So if you stay at 75, 15, and then just use the 3 for your triggers, you're not going to have anywhere near the amount of noise. The other thing that I like about it is that they're all 5s, right? So 78 is 5 into the daily. 15 is 5, just right close to 5 into the 78, and then obviously 3 into 15, that's another 5. So you can keep everything consistent using that. I had an email from someone who's bringing this up, and he's actually done some back testing on it, and I agree with him. I have no problem with switching this to a 78 instead of a 60. I've just gone through, and I know like the noise that happens on the 60s. There's extra little noise. one of these old dogs, new tricks. Now, if I were going to spend a lot of time day trading and or I should say swing trading, I probably would switch this to a 78. All right. I would probably do that because if I'm triggering off the hourly-ish time frame, I want full bars. I'd either have a 65 or a 78. I don't like the little minuscule 30-minute bar either at the beginning of the day or at the end of the day. So just kind of keep that in mind. I've mentioned that over time. I think that is important. All right. Now, in terms of the number of stocks. So first of all, I would be very focused. Okay. If I'm day trading, I might just have 4 indexes that I'm watching, indices, right? I've got 4 of these. And it's possible in a really active market, you could just trade the spider. And for those of you who want to do, the E-mini, using the futures contracts, there's nothing wrong with that. But again, just got to be real careful about forcing positions. If you just have one index that you're watching, you'll have the tendency, especially if it's not an incredibly active market, to force things. So have the 4 up. If you notice that you're getting a lot of signals, then you can just zero in on one of these. You don't have to focus on all of them, but that is a good way to do it. Now, when you're trading and you're putting trades on, I would say, unless you're experienced, you really only want to have one trade on at a time. All right. If you have more than one, you got to. Now, when I started a second hedge fund in around 2016, something like that, 2017. I had some pretty sophisticated techniques where I had 2 or 3 trades on at one time, trading off of a 5-minute and a 1-minute. All right. But you've got to know, and I think you've got to be a chart trader at that point, have all your signals up on your screen so you know exactly what's taking place. But for the most part, 99% of the time, I would probably just recommend having one day trade on at a time. All right. Let's switch over to swing trading. All right. And now what I've done is I've changed this. Now I've got a weekly in the bottom left. All right. I've got a daily here. I've got an hourly up here. All right. And then a 10-minute. All right. Now, what I said before, you can change this to a 78 and 15, and you're not going to do any harm at all. In fact, you'll probably improve your signals because the 78 is 5 is the daily divided by 5. All right. It's going to be very similar. The signals are going to get a little bit more similar. And what you'll notice is there won't be as much overrun on the MACD. All right. Now, I've learned to live with that. All right. I accept the fact that there's going to be some overrun in the signals on the hourly, and I'm okay with that. But that doesn't mean that you have to be. All right. If you want the signals to be a little bit more consistent, then I would switch to a 78. I'm not pushing it. Obviously, in all the stuff that I do and most of the stuff that I put out is I'm using a 60 and 10. I've traded every one of these, though. I've done it with a 65 and a 10. I've done it with a 78 and a 15. I've done it with a 60 and a 10. So don't feel like you have to do it one way or another. Figure out which one seems to work best for you. And I'll give you this small piece of information. If you're going to trade a lot, do a lot of swing trades where you want to be in and out over the course of, say, a couple days to a couple weeks, then try using the 78-minute and the 15-minute and see if it helps you in terms of just, like improving the signals, getting a little bit more reliable signals. Look, it's not going to turn you from a losing trader to a winning trader, okay? But it might help you on the margins. It might help you a little bit, and it might give you a little bit more confidence in the signals that take place on the hourly time frame, which I call the hourly, the 65 or the 78. Any of those would qualify as that kind of high-end intraday time frame. All right. So just kind of keep that in mind. Now, in terms of the number, all right. So this is where it gets a little bit more interesting. So I've got the XLK up right now, and we're looking at pretty good momentum trying to come back in this after a surge to the downside. We're getting pretty good momentum coming back in. Right. We've got this little pause taking place on the 10-minute as opposed to any kind of a reversal right now. But the point I want to make is that right now I'm just showing 11 symbols. These are the XLKs. All right. I mean, the XLs, the major sector spiders. You can do swing trading just off of these 11 symbols. You don't have to have a monster list. All right. Now, the people who are my subscribers, I'm doing a lot of the work for you. If you want to use if you want to use my list to swing trade, I have absolutely no problem. In fact, I recommend it. All right. But you got to know what you're looking for. And obviously we're going to lean a lot on these two time frames up here for those signals. We're looking for pullbacks in strong trends. So you've got this bias in place of the list I'm sending, and then we're looking for signals off the smaller time frames. It's a really good way to do it. My point is this. Don't have 50 or 60 or 70 stocks that you're trying to swing trade, and try and identify which of those to time. It's just going to be a lot of work. So you can take my list that I'm sending across and narrow it down very, very quickly to the ones for the week that have the potential to be a setup on that hourly time frame. And if you do that, I think it'll be a big help. All right. But if you don't, and you just want to use the XLs, you can do that. Or you could create your own list of, say, somewhere around 10 to 15 symbols that are consistent or are very heavily traded, probably stocks between 50 and 150 in terms of price, and are very, very heavy volume, right? And they have some ATR. And if you do that, you could probably pick out a list of stocks that, would be good swing trading candidates if you want. But, I think the XLs are a good starting point. All right. Now, in terms of the number of holdings, so if I'm swing trading, I like to have a max of 4. Okay. So you could think about it in terms of 25% in each. Never invest more. And you probably could make it 5 and keep it at 20%, right? In other words, 20% is the max holding you would have in your of equity. So if you have a $100,000 account, you'd never put more than 20,000 in one position. Okay. Now, depending on how aggressive you could be, this is the absolute max, but this would be the range that I would have. So it'd be 4 to 5 and 20 to 25% in terms of positions. It doesn't mean you have to have that many on. Okay, you could just have 1 or 2 swing trades on at a time, but this would be the max. All right, I wouldn't have more than this on at any given time, and it really depends on the environment. As I've been saying to my subscribers, I don't really think this is the greatest environment for swing trading personally, just based on all the volatility and all the news and all the the Fed speak and just every single economic data having an influence on the market this way. Tends not to be the greatest environment for swing trading. Now, finally, I know for my subscribers, I am skipping a time frame, but I think you can lump these somewhat together. And what I talk about in one of my courses is how you could mix and match the long-term monthly, weekly with the weekly, daily signals, and have 50% of your trades in those and 50% of your trades in the longer-term ones. All right, so what I would say is I've got the monthly, weekly, daily, hourly. Now, most of the time on the hourly, I'm not really using that, but there are times when I'm going to want to take a signal off the daily for a longer term trade. All right. And if I do that, I probably want to time it off the hourly. So you can obviously use multiple time frames for this. Now, I've just put in a list of symbols. It's not exactly up to date, but it's a list of symbols that are pretty attractive. Like you can see this QFIN, big base breakout here, and we'd be looking for some kind of an entry if we're trading weekly, daily, or if we're trading monthly, weekly, we'd be looking for the next entry point. Now, what I would say for this is that you can have a much larger list. You can take the list for subscribers. Obviously, the whole list that I send across can be used for these type of signals. The other thing you could do is have some screens to run, or you can do your own, review. If you don't take my service, you can do your own review and try and come up with names that have both trend and momentum on the bigger time frames, and then look for entry points. So we've got this. Situation where if we're trading longer term, I like as a starting point. This is a starting point. This is the way I would think. And this comes straight from W.D. Gann's original trading rules, where he started out as a day trader, but by the time he was done, over the course of 30, 40, 50 years, by the end, he was looking at long-term swing trades, which I would consider to even be like monthly, weekly, daily type setups. All right. And what he said was you would take your money and divide it by 10. All right. So we've got 10 symbols. or we have that money is divided by 10. So let's just say we have 100K. All right. 100K, we divide it by 10 and we get 10,000 per symbol. All right. So per trade. And then we divide that by 10. And that tells us how much we can risk. So we're basically on a $100,000 account, you'd risk $1,000 per trade, and that's 1% of your equity. All right, to your stop. All right, that means if I buy a stock at 50, all right, and I'm taking 10% of that, I'm basically going to risk $5 in a trade like that, and that would be 1%, and that would be $1,000 per trade. All right. So I'm basically telling you, as a great starting point is to have 10 holdings. 10 holdings is what I would do. Now, what invariably happens, especially if you're trading monthly, weekly, this doesn't happen as much on the weekly dailies, but if you're trading longer term, you're going to end up with about 15. All right. Because what's going to end up happening is you're going to hit a target, right? You're going to take a partial profit, and then you're going to have some cash develop if you do that a few times, or you might get stopped out every now and again, but you're going to have this situation. What invariably happens to me over time is you build up these positions where you've taken targets, you might be at a break even, you've taken 1 or 2 targets, and they're trending to the upside. And, you know, you could be in them for a long time. I have some stocks that I'm in right now that I've been in that are actually getting very close to long-term capital gains now, held for almost a year. And so the number of holdings can actually keep growing if you're in a decent environment, a decent market. All right. Now, I would say the absolute minimum way you want to divide it up is making sure you don't risk more than 1% per trade. All right. Now, I prefer, so you can use this as a starting point. You don't have to do it exactly this way. You could risk a little bit less dollar amount and have a few more holdings. All right. You could have 12 to 15 holdings if you want to start. But what I have noticed is that if I want to start and I want to have 15 holdings, it takes a long time to get invested that way. When you have just 10 holdings, in a good environment, you can get pretty invested pretty quickly. All right. And the other side of it is that if the market turns against you, you can quickly go to cash. You sell 3 or 4 stocks and all of a sudden you've got 30, 40% stock in cash. So I do like the starting point of 10. And when you're in a good environment, it could work up to 15. In a really, really good environment, it could be as high as 20 holdings that you have where you just keep adding, you keep taking partial profits. Now, these positions are a little bit smaller as they're growing, as a part of the whole account, but you're adding new positions on. And so that's kind of how I would handle it. So I would start with 10, and you can make that divided by, you could have the weekly dailies, right? Be maybe 2 or 3 of those, 3 or 4, something like that. And then you could have the monthly weeklies be, somewhere around, 5 or 6. Maybe higher, 7 to 8. So it really depends on how you want to be. If you want to be a longer term trader, there's nothing wrong with that. If you want to be a little bit more like an intermediate term trader, you could have more of these. Just realize the size of these positions are probably going to be a little bit bigger, all right, because your stops are going to be a lot tighter. All right, so you've got to do the math a little bit. Just kind of try and keep it close to this 10 stock level. Again, it could be a little bit more, could be a little bit less, especially when you're starting. But I think it is a really good starting point for this. So hopefully this helps. Let me know if you have any questions.